All right. Hello, everyone. Happy Monday. Welcome to your market check-in here with myself, Greta Wall, your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussion, here's a quick disclosure of Derrick's current positions as of our recording here today on July 13th, 2026. Can't believe we're already almost halfway through July, Derrick. It's crazy. But how's your Monday going so far?
Not bad, considering that the market is getting smoked to new lows right now as we're having this conversation. The Qs are down 1.75%. They're pretty smoked. The SPYs are down 0.7%. And as you showed with the position disclosure, I am almost 100% long outside of SpaceX. I'm green. So, and I'm pretty decently green. So being green when the market's down and you're long, you can't ask for anything better than that. But the reason why I'm green is because of one of the biggest themes of this market right now, which is rotation and dispersion. So the semiconductors are weaker today, and I do have a couple semiconductor longs that I'm down some money on. But when semiconductors are weak, it means that the Qs are going to be down, but they're going to rotate into other things. So IGV software is able to be up 0.7% within the confines of the market being down that much. The MAGs is down today, but not nearly as bad as the Qs. And at one point, this MAG 7 ETF was green. So I've got some oil names. XLE is sitting up 2.5% on the day. Financials are still green. So the name of this game right now is still dispersion and rotation until that changes. And by having kind of a good barbell of long equities, I find that I've been able to do pretty well on days where the semiconductors are strong and everything else is weak. But I also find that I'm able to do pretty well when the semiconductors are weak and everything else is strong until we see correlations begin to increase across the board. This is just the normal of this market right now.
All right. The title of our stream is Chip Stock Slide because, as you mentioned, the semis are dropping as the market, rotates into other names, as you mentioned. This comes after you and I haven't talked since the SK Hynix debut. That was on Friday. Started trading as SKHYV. Now we're SKHY. A new player in the space for U.S. traders. Obviously, not a new player in the space as a company. But a new player in the stock space, so obviously impacting names like Micron, SanDisk, etc. So what do you think about the broader, we're seeing the chip stocks as a whole down today, but the broader impact long-term of having another name in that memory space and what it means for stocks like Micron and SanDisk?
I honestly don't think that it's overly impactful. We've already had this as a listing in Korea for quite some time. So now the main difference is that we have this as a listing here in the United States as well. But ADRs tend to track their overseas components. So I tend to not like trading ADRs personally because, right now this is a new enough of a product and Korea has been so hot from a trading perspective that we'll probably get pretty good movement in SK Hynix. But generally speaking, ADRs don't trade well on the U.S. market. They trade pretty big overseas where they're based out of. Then we get really big gaps up or down based on what it did overseas. And then the trading is a little bit tighter during our session. So if you look at a chart of like Toyota or something on the daily chart, you're going to see that this thing has gaps that are typically larger than its actual intraday ranges. The biggest thing I think to pay attention to, if anything, or the extra thing to note about this issuance is that it is just additional supply. So, one of the things that I think that we highlighted in a recent conversation, and it's something to begin to pay attention to, is just this idea of supply and demand when it comes to the market overall. Very simply put, if there's only so many investors that are out there, but we are unleashing new supply via IPOs and secondaries, that just adds an extra weight on the market because that supply has to be absorbed by buyers. So, one of the most interesting stats, I think, for me personally is that over the course of my 16 plus year career as a trader with T3, I started with T3 in 2010. Every single year that I've been a trader here, except for 2021, the market shrunk more than it expanded, meaning that buybacks and M&A shrunk the market more than IPOs and secondary offerings increased the overall supply of the market. So structurally, what that does is it just kind of creates this underlying bid that's kind of forever there in the marketplace as the overall amount of stock gets smaller. But if you get SpaceX and SK Hynix and then Anthropic and then OpenAI and one after the next, we have a risk of going into a stock market that is expanding, which doesn't necessarily mean that we have to go down, but it's just something to pay attention to. Can the market absorb all the additional supply in the equity market? While at the same time, there's a lot of supply that is coming from the fixed income market as well.
Obviously, another thing continuing to impact this market is the ongoing back and forth with Iran and whether the war is over or continuing over and over again. Really, though, the impact is the oil market and then that affecting things with the equities market and the economy. So what do you think about the latest impacts of that conflict and the oil market and what the stock market is saying about how investors feel about what's happening there?
Sure. So the first thing I would note about this is I feel like the movements are getting smaller off of the news, which is normal, right? I mean, USO is up 5% this morning, but take for example Russia-Ukraine. When Russia-Ukraine, that war was first happening, it was moving our market in a pretty big way. Now over time, it's at a point where new headlines on Russia and Ukraine, they don't even move us a tick. I'm sure if we had a full peace resolution to that war, we would move a little bit on it, but I don't think that the move would be too dramatic. So it does make sense that the movements are getting a little bit smaller on the Iranian conflict as investors just kind of get a little bit more jaded on it over time. I mean, it's like, all right, the price of oil is up 5%, but who cares because Meta announced that they're going to be increasing their size of one of their data centers and pumping an extra 50 billion in it or something down in, I think, Louisiana was a headline out this morning. So who cares if the price of oil is going on if that happens? Obviously, saying that a little bit tongue in cheek because it does matter. One of the biggest threats to this stock market on a more macro perspective, though it hasn't really impacted us too much, is inflation. And we're actually due for a CPI number this week. I think that we're going to see the first moderate downtick in inflation in almost 2 years. It's been 2 years since we saw a downtick in these inflation numbers. But the fact of the matter is inflation is too high. And while energy is taken out of the core inflation numbers for good reason, in my opinion, core inflation is still too high, and there is some kind of secondary impact on like what oil does on core inflation. Just for example, if the price of oil is higher, then airline tickets are going to move higher, which that will impact core inflation. So the biggest thing here is a little bit circular. It is this war with Iran increasing the price of oil again, which increases inflation again, which therefore makes it so that interest rates get priced higher. And interest rates being priced higher is what really hits the market down more than anything because it creates multiple contraction in the equity market. So that's the big thing we've got to pay attention to. And then it is also something, I still read these reports. I don't know how much this matters. I'm not an expert in the oil space about dwindling global strategic reserves. So you could hit a point here where I don't know what the timeline is on that, but if we can't get the Strait of Hormuz open and we aren't able to get oil in a bigger way from other places, as these reserves dwindle down, especially in a lot of Asian countries, it could start having a larger impact again at some point. Just something I'm keeping in the back of my head because so far I haven't actually seen any price action that would confirm that this is an immediate concern.
Here we are again, and it is earnings season starting. again, I feel like we are always
Doesn't
talking
end
about
anymore. It just doesn't
the
end
beginning of earnings season. So things kick off tomorrow morning. JP Morgan Chase, Citigroup, Wells Fargo. They're like all tomorrow, except for I think Morgan Stanley's on Wednesday, which is weird. They're usually kind of split between 3 days. And now they're on Tuesdays, not Fridays. Everything changes. But anyway, JP Morgan Chase, Citi, Wells Fargo, Bank of America, the big banks are reporting tomorrow morning. Sometimes the financials aren't always like the most exciting reports, but I feel like this round of reports is a little bit different, especially after the SpaceX IPO, when it comes to like the investment banks and stuff like that. So what do you think about the financials and then this upcoming earnings season as a whole? And then also this week, on top of the financial names, we do have Taiwan Semiconductor and ASML, which are two big semi companies that are really important to kind of give a preview of what that space might look like this earnings season, after we just finished with Micron like a couple weeks ago from last season. So what do you think about earnings this week and this season?
Sure. So first of all, on the financials have been hot recently. And even though I haven't really been overly involved in the sector, my team and I, we've had some really good call outs on the way up on that. So hopefully some traders have participated because it's been one of the best sectors. XLF, which is green right now, within the confines of the market being smoked, is one of the direct beneficiaries of the rotation dispersion trade that we were talking about. It seems like even though logically it doesn't make any sense, you really have to understand market structure to understand why these dynamics are happening. Every time semiconductors are selling down, it seems like the financials are having a bid. And since this SOXX has not really continued and it's been a little bit weak over the course of the last couple of months, these financials have broken out and continued. So the reports will be interesting on these because the stocks are up a lot into those reports. And I think that earnings expectations across the board, not just for the financials, but across the S&P as a whole, are pretty elevated going into these reports. So we have to see if they're able to meet and exceed those expectations or if they come short. And as you know, one of my favorite things to look at going into an earnings report is how a stock has performed prior to the report, because I find that, if a stock has done really well into an earnings report, it just sets the bar that much higher. A lot of times a good report, an inline report, a small beat won't be good enough, and it will actually cause the stocks to sell down. So, we'll see what happens with these financials. I'm generally optimistic and generally bullish. I know that the expectations are lofty for a lot of earnings growth, particularly from tech and from energy, but I think that they're going to be met. And, then we'll see if this big bull flag, this big consolidation in the S&P is able to break out during earnings season or not.
All right. So here on a Monday where the market's down and we saw your position disclosure, we see that you are long. You're long except for SpaceX. And like you said at the beginning, it's been a good Monday for you, even with the market down. What setups do you like here, if any, and any charts that are interesting to you that you'd like to go through?
Cool. Yeah. All right. Let's pull up the charts and see how things are looking here. Okay. So I'm a top-down approach trader, right? So I always want to start with the S&P, the NASDAQ, and the Russell. I want to look at the three indexes. I want to start with bigger picture technical analysis before I work my way down into a smaller time frame. And the idea here, as I'm looking at the S&P, the NASDAQ, and the Russell, which I'm happy to do with you, is just an exercise for anybody who's listening.
Yeah, for sure.
What I'm really trying to do is I'm asking myself, based on what I see with these charts, what is the message of the market? And if I have a clear, concise message, I have a general understanding of what I should do. For example, if the S&P, the NASDAQ, and the Russell are all bullish looking charts, then generally for any stock I want to be looking at, I want to be long. I don't want to be short. Obviously, that's a general rule. Other factors have to be taken into consideration, such as extension and relative strength and relative weakness. But it's just a great starting point. If I'm going long and the S&P is set to move higher, I'm going to have a higher probability of success in anything I do than if I'm going short and the S&P is moving higher. So looking at this chart of the SPYs here, the S&P, you can see that we've been in like a 2.5 month consolidation at this point. So we've been going sideways for 2.5 months. And that actually has helped to we had a really big move into this consolidation. So this has helped to, I think, kind of reset the fundamentals a little bit. Sometimes when the market is able to move sideways, and this certainly happened over the course of our consolidation that we had in November, December, January, February, the market actually is getting cheaper even while the indexes are moving sideways from a fundamental perspective, because earnings expectations are moving higher. And also just this idea behind corporate buybacks, it actually makes stocks cheaper at the same trading price. So somewhat similar but different to that November, December, January, February consolidation. This move sideways here for May, June, and July so far has actually helped to kind of reset, I think, both the technicals and the fundamentals. And that circles back to what, a bull flag actually is, right? So if we were trending higher and now we went sideways for a few months, this is a bullish consolidation pattern here that technically has a higher probability of breaking up than breaking down. Doesn't mean that it can't break down. And we do have this concept in trading: from a failed move comes a fast move. So there's no such thing as 100%, and you want to take that into consideration. But this is a pretty good looking bullish S&P so far. I'd get a little bit concerned if we got back below 740. And then I'd get really concerned if we lost like 725. So those are the downside levels I'm paying attention to, where the message of the S&P can change. On the upside, it's really about this resistance between like 756 and 760. If we can break above that, then we're going to be looking full on bullish or breaking out again. And while we're in the middle, while we're in the consolidation, it just means that we are a little bit more neutral. So in sum, I would describe where the SPY is right now as bullish neutral. So that's the message that the S&P technicals are giving. Now the Qs are a little bit more beholden to the semiconductors. They've been moving with semiconductors incredibly more so than mags or software or anything else, all about how the semis trade. And as you can see here with the SOXX chart, I'll pull that up really quick. This chart has deteriorated. It's not broken, it's not bearish, but it's definitely deteriorated, holding below the moving averages, being a little bit weaker, correcting a little bit. We'll see what happens with the earnings reports. But the Qs kind of being below this like 720 inflection point and the midpoint of this 2.5 month consolidation, I would describe these as neutral bearish. So already I have a little bit of a mixed message from the market. SPYs are neutral bullish but haven't broken out. Qs are neutral bearish. There's a little bit of a higher potential that this pattern could break down instead of breaking out, because that's where the weakness is. And then finally, the IWM, which is much more beholden to interest rates in the TLT. Rates are higher today, so that tends to make this IWM weaker. Overall, this is still pretty bullish looking index. You got a big bull wedge here that's kind of building out, but this thing needs to break up. And if it were to lose 290 on a closing basis, this can go from a bullish looking chart to like bearish neutral really quickly. But for the moment, it's still intact. It's still okay. I'd like to see it get above 295 and get above 300 relatively soon. So the bottom line is we are in a broader consolidation for the market. I think we're going to need earnings season to resolve that. And we do have a little bit of a mixed message. So if I've got a mixed message, what does that tell me? It means I can't have as much conviction as I would have otherwise. And therefore, any new trades, new setups that I'm looking to put on, I should do with a little bit less size and a little bit less risk than I would otherwise, because I can't have the same conviction in a mixed message market as I would in a market that is giving me the same story across the board. So that's kind of our starting point. But when you break things down a little bit further, I do see broad improvement here on a lot of important charts. The MAGS chart, which has been a big source of weakness in June, has really recovered. It's looking a lot more bullish. I love this Thursday move into Friday that we had on MAGS. Again, the ETF that represents the Magnificent Seven overall. So this looks pretty productive. IGV has gotten a lot more productive. This was the worst area for quite some time. This IGV software ETF went from $117 in October to a low of $74 in April. Had a pretty big recovery, and now this is technically a bigger picture higher low, and now another potential higher low, and we can see if this can break above 96 and start looking good. So MAGS looks better. MAGS looks great, actually, and Apple overall looks phenomenal, even if maybe today it got a little bit ahead of itself. Some of those charts are looking great. IGV is improving, but the SOXX is weakened out a little bit. I think that this is going to lead to a viable dip in semiconductors still at this point. Everything that I'm looking at points to the semiconductors not being done. Now, taking a look at these charts, we then also need to think about this market dynamic concept of dispersion that you and I were already talking about. For me, I've been having, pretty consistently, 17 swing positions on. Every single one of them has been long except for SpaceX. And it's actually been yielding phenomenal results for me overall for the course of the last couple of months, because what keeps happening, and today's a perfect example of it, I am negative in SMH today. I am negative in NVIDIA today on swing positions that I have. But my P&L that I have on Microsoft long, on, I got out of Chevron today, but Chevron giving it up move on VG, which is an energy name. So the rotation under the surface, the longs that I have that are green and trading well today are outweighing the longs that I have that are red and are weak. But then the opposite happens on a day like Friday, where on that day, it's like the semiconductors were really strong, but then everything else was really weak. Mags was maybe a little bit weaker. Software is a little bit weaker. Financials are a little bit weaker. But by having the semiconductors on, I still find that my P&L is being really consistently green by kind of having a barbell of both sides to take advantage of that dispersion. So then what I keep doing is buying every pullback in what happens to be weak on that day, selling what happens to be strong on that day. Then maybe tomorrow they flip and I'm rebuying what was strong yesterday into that weakness, and I'm reselling what was weak yesterday into that strength. And it's just been a rinse and repeat process here over the course of this consolidation period. It's been so hallmarked by this dispersion that has just consistently paid. Will that work forever? No, it won't. At some point, you would expect that correlations are going to increase again, but you really need to have some sort of a catalyst to increase those correlations. And I don't really see that in the short run unless earnings season were to dramatically disappoint, or something about this Iranian war were to really heat up in such a way where it actually starts to impact somehow AI CapEx spend, which seems almost ridiculous. But yeah, I mean, that's been the trade. It's been the approach. It's what I'm still doing here. I am a little bit nervous about bigger picture positioning as we get into some weaker August and September seasonality. But overall, things are good, and that's how I've been trading it.
All right, great view of the market there, Derek, and how you're thinking about it. One thing I forgot to ask you about, another big catalyst this week is, of course, inflation. CPI tomorrow, PPI on Wednesday, and the Fed officials this morning saying if we get another hot core reading, then a rate hike is going to be needed in the near term. And so that's, a message for the market on maybe hikes are coming. So what do you think about this week's reports in particular, and what they could do to this market either way?
Sure. So this week's report is going to be really important. I think that I mentioned it briefly, expecting to see the first downtick in inflation in 2 years on a single report, even if that one 2 years ago was pretty small, and this one is also probably going to be pretty small, and already we're seeing the price of oil go back up. With that said, though, even with this downtick that we're expecting, inflation is a problem. It's way too high. And the responsible thing probably would be, well, honestly, the responsible thing wouldn't be for the Fed to hike. It would be for the federal government to make the adjustments necessary to end inflation, because it's been the decisions of the federal government that have caused this inflation to begin with, in my opinion, like tariffs, like this war. And if they can end the war and they can eliminate tariffs, that would be the best way to bring inflation down, because then you could bring it down without having a hike. And that would be really bullish. So that would be the most responsible thing that I think could happen. But in reality, what is going to happen is that the Fed probably should hike, but they won't. But at a minimum, that means that they're not going to be able to cut. But they're not going to hike because our new Federal Reserve president is beholden to the administration, and it's just not going to happen. I mean, we saw what happened with Jerome Powell when Jerome Powell was consistently doing the right thing on leaving rates steady, because just inflation has been too high, and you can't have a stable economy without stable prices. So the bottom line is I think that we're just stuck in this situation where inflation is going to stay moderately too high for quite some time. We're not going to hike, but we're also not going to get the cuts. So kind of everybody's left unhappy. Some people want to, hike in order to get inflation lower. That would be more of the camp that I'm in. Other people want to cut to stimulate the economy and help to improve housing. But that isn't going to be able to happen with rates being too high either. So it does remain an important report. I really, really hope that we're able to have a number that's even less than expectations, because that would really help this market to propel higher.
All right. Any final thoughts for you on this market before I let you go?
No, I think we covered it. We had a really good look at the indexes here. I think that this earnings season is going to be a really important earnings season, and will probably be the difference on whether or not this market's able to break out of this consolidation to the upside or not. And then I get a little bit more nervous as we get into August and September about some seasonality and positioning stuff. But let's take it day to day, and you and I will be revisiting this information each week as we get a little bit closer to that potentially scary time.
For sure. All right. Derrick is a real trader, so I want to let him get back to that. Again, he's the head trader at T3 Trading Group. If you have any interest in working with him and his team, you can go to t3live.com/DOLive, fill that form out there, and someone will be in contact with you. All traders with T3 Trading Group work with Derrick on a daily basis, so you'll get his insights every single day, all day long during the market hours and more. So again, t3live.com/DOLive to fill that out. Derrick, have a great rest of your week. It's going to be a big one. Lots happening starting tomorrow, so enjoy.
Thanks, Greta. Talk to you next time.
All right, bye.